Thank you for being here on behalf of the Hunter team and the Hunter family and the Hunter everything. Seriously, thank you all for being here. It's great to have conferences back, and we're super excited. We can't do it without you guys showing up. So thank you for being here. 2 more days, another day and a half. So I'm excited. I love this panel. This is, we call it Main Street, but this is us. I think this is who our attendee is. This is the conversation we're all sort of having in the hallway and the networking sessions and in the car right over here and at dinner and the like. So I'm hoping the same conversation that we've been having in the back and that we have all the time, we're just going to have it in front of you guys and let you in. So without further ado, and if you got questions, raise your hand. I'll try and holler on you. I mean that because it's just casual, but I'll try and go. Al Patel, Baywood Hotels, Mehul Patel, Newcrest Image, Greg Friedman, Peachtree, and Mitch at Vision. Stalwarts of our industry, own a ton of hotels, very influential. So I want to know what's in their minds, as hopefully you guys do as well. So I don't know, Mitch, I'm going to start with you. I was going to start and ask you what you did in 21 because you were the only panel member up here. You know what? I'm going to do that. Tell me what you've been up to in the last year, and then I'll get to all the questions that they were asking.
Absolutely. I'm glad to be back, that's for sure. So 21, we are historically, look, every company creates value differently. We're developers. We've developed over 60 hotels, and so we had a robust pipeline prior to COVID, and we were absolutely focused on getting that pipeline complete. So we opened 7 hotels in 21, and historically we are long-term holders, and COVID kind of changed that attitude for us to some degree. We didn't know that the values would be that strong. We were getting some great offers, and we had hotels in urban markets where it was going to take a while to recover. So if someone was willing to pay us numbers that we were underwriting at a greater value than what we were underwriting in 19, and it was going to take us 3, 4, 5 years to get to that point. So we said, you know what, let's exit these hotels. So we exited about 6 hotels for about $190 million. And so we were busy doing that.
Yeah, I mean, before that, just curious, how many hotels did you ever sold?
Probably about 6.
There you go.
In 24 years.
Wow. And then you sell 6.
Yeah.
Interesting times. Greg, Peachtree Hotel Group, I got to brag on Greg real fast. So Greg, if I may, started just a small sort of private equity company locally out of Atlanta doing onesie-twosie hotels, and then turned into funds. Help me out, $50 million, $100 million funds, as everyone does. And dare I ask, what have you been up to in the last 12 months? But now you just announced a $1 billion fund, because everybody's doing $1 billion funds these days, right?
Yeah, everybody's got to do bigger.
Everybody's got to go bigger.
Yep.
So what have your last 12 months been like?
Yeah, so for us, I mean, because we invest up and down the capital stack as it relates to hotels. So we invest both on the equity side as well as the debt side. So we've been very active, not only developing hotels. We've got probably about 24 different development projects in our pipeline. Currently we've got about a half dozen projects under construction. We've been very active on the the acquisition side. We bought about 17 assets over the last 12 months. And a lot of that's been really over the last 9 months or so. We've been very, and also on the debt side, we've been super active there. We've, lent probably over, $1 billion of, direct lending to different hotel groups to help, recap existing assets, construction loans. But we've also been very active in just buying, debt. We bought over, since the beginning of the pandemic, we bought over, 200 first mortgage, loans secured by hotel assets. So we've been, super active, pretty much everywhere on the investment side.
Mehul, again, I'm going to ask what you've been up to the last 12 months, but I got to preface it. Mehul's been very active, probably one of the best stories out there in our industry, if I really can. It's a little bit of self-made man. Some of us cheated along the way and took over our father's business. Mehul is one of the few who, dare I say, did it on his own. And it's the second or third time, but Mehul sold, if you saw the headlines, I can say it, sold $822 million worth of his hotels to Summit, publicly traded REIT, which I don't think has been done before by one of what I will call one of us. So congratulations.
Thank you, Teague.
What made you make that decision? Why'd you do it? How do you feel about it? Do you regret it?
No, I feel really good about being that transaction. So Newcrest Image has probably bought and sold 210 hotel in last 15 years. So we've been heavy transacted company overall. But pre-pandemic, we started, we bought a bank in 2019. So our plan was to diversification ongoing forward. But I think pandemic just allow us to fast forward that diversification growth really fast forward. So we were able to exit. I mean, last, when you talk about 12 months, we opened 5 brand new hotels. One was with Peachtree, we opened and we sold it last year. And one with Baywood, we're opening tomorrow, Canopy in New Orleans, that will be sold to Summit also. So it's great to see both of these guys that we had opportunity to do business with it. So, Newcrest Image has always been a transaction mind. We're growth oriented, like we still have 5 hotels that are under development today. We have few bits out there that we're looking to buy. We bought 9 G6 portfolio from you. Thank you for that. So, for us, transaction is kind of a daily journey for us. We're looking at, opportunity, just, different market. But I think the big transaction with Summit was very attractive for us to find an exit of management, PropCo side and OpCo side, and now allow us to be a truly investment company rather than being day to day.
So I'm going to stay here and pick on you a little bit. Was it COVID? Were you trying to sell pre-COVID? What made you say, hey, it's time to exit and make a mass sale?
I think there's so many answers to that question. It wasn't
That's why I
like
asked.
COVID was one thing, but diversification was one, COVID was one. Third one was, what do I want to do? Every morning when I wake up, what do I want to do? Fourth thing was how the world was changing, right? Merger and acquisition, labor challenge, inflation, all this hit right post-COVID. So when you add everything and challenges in our industry, when you look at everything, you're like, okay, I think it's time to step back and just look at different lens. So we were able to sell both sides of it. So it wasn't just COVID was one answer. We still love the travel space, so we'll continue to heavily invest in travel, but it'll allow us to just pull back and look at what do we want to do future. So that's the game plan that we put together, and we were able to accomplish pretty successfully.
So I'm going to circle back and ask you what you want to do in the future and what you're going to do with the money. But Al, I'm coming to you. So Al, prolific developer, own a bunch of hotels, great family. You guys have been really good. Let's go backwards and tell me what your 2012 looked like.
2021, I'm assuming.
12 months, 2020.
But yeah, we opened about, I think, 11 hotels in 2021. Obviously, not great times to be opening hotels, but fortunately, most of them were in the extended stay space, so it did add to our enterprise. Those hotels did. Our pipeline was pretty much, we usually add to the pipeline every year, and in 2020, we didn't really add to the pipeline. So in 2021, after we saw kind of this big resurgence, kind of, let's say, late spring, early summer last year, especially in the southern and western states, we're trying to replenish that pipeline right now. So we went from having a pipeline of just 1 or 2 hotels, which typically we have 20 or so, and we're replenishing that pipeline. We're up to about a dozen in the pipeline right now, and we hope to get that back up to 20 or so by the end of this year.
So you're bullish on development. Is that just because that's who you are?
It's who we are. It's what we know. We like to think that we're adding value. We are acquiring also when it makes sense. So we have such a good handle on what replacement costs are in every region. So if something is coming up where it makes sense for us on the brands that we like, merging with the replacement cost kind of analysis, then we're making that jump also.
All right, I got to ask development. You went there. So talk to me about development costs, supply chain issues, all that stuff. What's happening with development?
So we had 2 projects pre-pandemic which were priced, ready to roll, and both of those, obviously the funding dried out on us. So we have a really good handle on those. Those pre-pandemic to post-pandemic, both are under construction now. It was about a 20% increase.
Okay.
So
20%. Mitch, would you agree with that? You're the developer too.
Absolutely. It's about anywhere from 15 to 22 to 23% we're seeing increases.
And how bad is supply chain issues?
Absolutely. I mean, supply chain has a lot to do with that. Of course, all the talk about inflation that we've been talking about as well, but the supply chain, it has a lot to do with that. We're talking about, go ahead.
How? Be specific. Go.
Yeah, I mean, look, there's certain materials you just can't get. you know, and there's obviously a lot of materials were coming from even China, and then even lumber from Canada and so forth. So the manufacturing, look, I just want to regress for a second. Those that have studied the supply chain, I mean, there is 100 moving parts that have to move seamlessly in order for the global supply chain to be in balance. Not just one, but 20 of those things have been disrupted because of COVID worldwide. And now we're trying to reignite all of that, right, back. And plants that were just completely shut down, both on foreign and domestically, are rebooting. That takes time. There's just no way that you're going to be able to bring that back, no matter how much we want to do that in 3 months, 6 months, 9 months. Absolutely, it will come back. It's just a matter of time, probably by the end of the year. Supply chain issues will probably get better, but that is causing havoc, absolutely, in our industry, and especially as developers in the construction industry.
So is that slowing down your thinking? How is that impacting your decision-making moving forward?
Yeah, so as a developer, I will tell you that this is the first time that I could remember in probably 18 years that we do not have a hotel under construction. So it was very intentional, our strategy. We had about 18 hotels in our pipeline, our development pipeline, around 18. And then 19, you know, I was up here with you, and you asked me a question on the economy, and I said the clouds are starting to form. Things are starting to slow down. You could just feel it, sense it. It's been 10 years since the last storm or downturn, and something is going to give. So we intentionally did not add a hotel to our development pipeline because we did not want to be stuck in it. But I got to tell you this, Teague, we were waiting for that storm, just like in 09, 10. In 09 and 10, we accelerated during the storm. We accelerated that pipeline to about 14, 15 hotels, and we opened those hotels in 11, 12, 13. And there couldn't be better hotels in our portfolio because of the basis that we were in. This time around, we thought that would be a great strategy, but that did not take place, right? I was here. You asked me a question 2 years ago in 19, and then last year, even in 20, like what's going on with construction costs? And I thought that those numbers would come down because that's what it has done historically due to supply and demand. But the supply chain challenges is what we did not anticipate, and of course the inflationary pressures that we did not anticipate. So it is a very difficult time to be a developer right now. As Al mentioned, we have hotels in the pipeline. We are pricing. It's about anywhere from 15, 18 to 20 to 2 to 24%. We got a quote by a reputable contractor on a project that we're doing in Nashville downtown, $400 a square foot. $400 a square foot.
And what, by comparison, what was it previously?
Well, back in 12, when we built in Nashville downtown, it was $125 a square foot. So land values have increased dramatically as well, as you know, greater than even construction costs.
Al, what would you echo on stay on development? What would you echo there?
Yeah, you know, so some things like steel, we used to buy 90 days in advance. Now we have to think about it 6 months in advance.
6 months.
So a lot of electrical components, we had to think about it, 2 months in advance. Now that's 4 or 5 months in advance. So all those things that Mitch talked about, you have to think about all these different things. And otherwise you don't want the job site just sitting waiting because everybody else is relying on everybody else's, trades to progress. And so, what that just means is we're having to buy things earlier in the process. So, and your interest costs go up because you're using more of your bank loan quickly as opposed to before you'd spread it over a 12-month period. So all of those things are adding to the cost.
Let's talk about lending. I mean, in the old days, you would go get the loan and then you would order all your materials. Now it seems like it's reversed. You order all your get everything ordered and then you're locking in your loan.
Yeah, I think a lot of that we'd have to start planning even like 30 to 90 days before we're actually closing the construction loan.
Yeah.
And things like that.
Same with FF&E, I'm guessing, right?
Yeah.
Greg, you're the lender.
Yeah, I mean,
You lended on construction?
What's that?
You lending on construction?
I mean, we're doing a fair amount of construction lending. That's one area that we've continued to lend into, just because it's an area that I think it still makes sense. it's tougher. I mean, a lot of projects have been shelved, and some of them are probably going to be shelved indefinitely. But there's still a lot of markets that are underserved, and I think even with some of the additional costs, which I don't think a lot of these costs is going to go away anytime soon, just because a lot of it's labor driven beyond just even the supply chain disruption. So I think it's just unfortunately since the Great Recession, I mean the construction industry is almost like a dying industry. I mean there's less labor force, there's less GCs, and it's just going to continue to put pressure, I think, on construction costs in general. But with that said, I mean we're committed to continue to be a construction lender. We've been a construction lender through the years, through Stonehill, which is our lending platform. But we're probably doing right now we probably have about $500 to $600 million of construction loans that we're financing different hotel development projects. So.
Well, on the loan side, Greg, are you getting more demand for construction or for standard acquisition?
I mean, we're seeing both right now. So I mean, the reality is over the short term, over the last 60 days, or really the last 30 days, with the crisis in Ukraine, I mean, you're starting to see debt spreads sort of blow out, which is it starts to minimize some of the CLOs that are willing to lend into our space. So we're seeing more demand on acquisitions and refinances because of it. But with that said, we're still seeing a lot of development financing opportunities just because there's not a lot of banks willing to finance new hotel projects today.
What's happening with lending in general? What's happening with rates? What's happening with LTVs?
Yeah, so comparing to the pre-pandemic levels, I mean we're still not back to where we were pre-pandemic. I mean I think for the most part there's a lot more debt in place today than it was 12 or 18 months ago. There's a lot of debt funds similar to us that are out there financing projects. But with that said, I mean I think in most cases most projects are being financed at spreads of like 500 to call it 5 to 7% or higher depending on the project.
What do you see happening going forward with rates?
I think rates are gonna. I mean, it's a good question. Obviously, I mean, rates are going up. I mean, clearly, we could debate, inflation, but unfortunately, they're going to be forced to continue to raise rates. So I think when you look at the actual spreads, against the indexes that you're pricing loans against, I mean, ultimately, there could be some compression in spreads to keep rates at some level where it's not increasing as fast as maybe rate increases that are occurring. But with that said, I mean I think ultimately rates are headed up here shortly. So
I think one thing I would add to development, I think timing is the major issues also. When you look at what happened, a lot of the architect, interior designer firm has merged, so they don't have enough bandwidth also. When you look at local jurisdictions, city, state, federal, they're not able to quickly go on do inspection also. That added more time. And then all the workforce, all the general contractor, the workforce are giving only 70% of output. Pre-pandemic, you could see, okay, we're getting 80% of output, 85% of output from the worker. So the productivity has also lessened. So when you look at the timing aspect of it, you could add easily 30% more time on the project schedule. So when you talk about inflation, all that is right, but when you talk about ROT, return on time, that 30% is very expensive because 30% cost you insurance, property tax, general condition, utilities. You talk about that. Normally, we don't think about that. So now you have to add another layer of it that you don't have a control over any of those segments. And many of the brand also downsize their, design construction. They're ramping up, but that also slows down. So when you talk about all the approval process, productivity, all that, there is a loss of time that added easily 4 to 6 months of construction time or more. I'm sure Alan, Mitch, or you guys have seen that time that also added that many of us may not thought about it. And so that is also coming into a play today.
So the obvious question, what's that doing to the value of existing assets?
As we're seeing, I mean,
That's the biggest question to you.
We'll have a session after.
Well, I mean, you're the pro at it, so that's a question goes to you, Teague.
I mean, I think they're going up, right? I mean, maybe this is on inflation, but all of this, you just can't get it. Oh, by the way, we're printing trillions of dollars. Sorry about that. I'm on a speech, but we had in January of 2020, we had 15 trillion in circulation. Today, we have 22 trillion in circulation. So the value of everything just went up. So now we're on inflation. The value of this bottle of water, this chair, oh, by the way, this hotel went up. It's costing you 30% more to build. It's costing you 30% more in time to build. The value of everything went up. We're selling now on pre-numbers. We'll keep coming. We're selling everything on pre-numbers. The conversations I just had, which is what we're doing, we're not waiting for numbers to come back. We're all seeing the numbers are coming back. We're believing the numbers are coming back. So we're selling on forward, 3-year forward projection. And the fun part of that is, oh, sure, well, 3-year projection, what is that, a 10 cap, a 9 cap? No, we'll take a 7. Thank you. Okay. And if we can do that, because if everyone's seeing it coming, I mean, that's where value has come, which is up at least 30% from where it was pre-COVID, which is material numbers. Everything we're selling right now has a bidding war. There's so much capital out there in circulation. Everything we're selling.
I think the challenge with acquisition is it has to pencil the number, right? When you go get a debt or equity, you could ask for 7 cap or whatever, but the number has to work on acquisition. Where on ground up development, you're able to show the future forecast that we haven't tested the water. So there is art and science both sides when you look at it. So I think, every asset in a different market, if you can underwrite and be able to turn around that asset and the demand is coming back, I think you could really justify value. But it's all over the board, 7, 8, 9, depending on the market.
You sound like a buyer now. Al?
Yeah, I mean, obviously, because of all the things that, Mehul talked about, we are acquiring, we're looking to acquire. We have not been very successful in our acquisition, in our processes. We're just getting outbid a lot of times, not just maybe sometimes we are the high bidder, but somebody else, knows the owner and, something like that. So it's been a difficult process to acquire. And we haven't been big acquisition in that space up till now. So we don't have that, that brand out there for that. But, our broker relationships and all that, we're trying to leverage all that. But obviously, all of that is just an extreme amount of competition, which is driving up the values.
Greg, what are you seeing for values?
Yeah, no, I was just going to say, I think you got to love development right now, just because we got so much choppiness right now with just everything, coming out of COVID. The reality is when you develop, I mean, it's going to take, nowadays it's going to take 18 to 24 months to get the property open. Not to mention you got to go through entitlements. By the time the property opens, yeah, it's going to cost a lot of money, but then you're going to stabilize out 3 years later, or technically you're stabilizing out 2-3 years later, or maybe 5 years. So you got a lot of runway to deal with the noise right now. So personally, I would rather be developing than buying. It's just harder to find stuff on the buy side right now. I think we need to push the cap rates up, Teague.
We're trying.
Yeah.
We're doing our part.
Unless we're selling, then keep it down. So.
All right, Mehul, let's pick on you. What are you doing with all the capital?
So-
What's the future for Mehul and Newcrest? Maybe I should go at it that way.
Very good question. So in last 12 months, part of at this conference, I came with a presentation and I met with few of the REITs to say, hey, I want to sell a portfolio. And first reaction, everybody looked at me like, why are you selling? Are you trying to screw us or what? Because if you want to sell something, that means something's wrong with it. But I think the plan came out of here. So the deal was crafted here. This is where I met and the transaction happened with Summit Hotel Properties. So our objective is to diversify our investment. That was the whole objective, because when COVID happened, we had 37 hotels and roughly 25 hotels were shut down for 45 days. 5 hotels were under construction. We were finishing it. And all the question came is this the business? Do I want to stay in it? And it kind of came up that we should have done more diversification in other classes. So we kind of came up with a playbook by saying, okay, we should have banking, real estate, alternative investment, and public equity. So today our dollar is spread across all 4 different 4 different silos that we're investing on it. And so far we have done a very good job very disciplined on growing each silos. We have a leader for each department, from banking, real estate, alternative, and public equities. And we're growing that. We love the travel space. We're not going away. Every month there is a hotel we're buying or selling. So our journey is continue in real estate space. We love the travel space. Travel is coming back. It's just matter of fact, maybe 3-6 months away. So we just want to figure out a different investment thesis. We're good developer. We're good transaction guys. As you can see our history, we have bought and sold 210 hotels. So it allows us to do continue more. So we feel like we're going to do more transaction buy and sell going forward on the real estate space on it. We're going to build more hotel also, and we talked about it. I think when you talk about development 20 years ago, the challenge was we learned how to build a hotel. 20 years ago, we were like looking for architect, looking for brand. So it was a struggle to learn how to build a hotel. Today, we become a pro by we built 77 ground-up construction. So when you look at the full circle, okay, we have done all of it, high-rise, historic projects, you name it, everything, right? Dual brand, triple brand, we did everything. So when we become pro and you look back and say, what would I go back and do it? Would I go build again? Yes, we would go build it. But you have to keep all that things in mind, what Al, Greg, Mitch talked about. Return, inflation, everything in there, but you could still be successful on doing all that part. But we're just becoming very nimble and very focused on it, driven, okay, 4 projects, let's do it right, 4 projects. So we're not going on quantity, we're going on quality of the project, and we're still mixing extended stay, lifestyle, luxury, all 3 segments into it. So we're just being a lot more pickier, disciplined, and all that mix of it. It allows us to give that flexibility to do that now, because we're just being an investment house. We sold our management contracts to Enbridge and made a investment in that. Were you going to say something?
No, but that reminded me.
So now we don't have to wake up every morning and look at what's occupancy and all that. Let somebody else worry about that. And every morning we wake up to do a deal. Either it's a development or acquisition, where can we go find a next deal? Or whether we're making a next investment in an alternative investment, whether in US or overseas or somewhere. So we're all become investment house now, pretty much investing in all 4 different areas.
Yeah, I mean, you've come a long way. I had a lot of questions. One was going to be, what would be your advice to sort of the new hotelier, to Mehul 20 years ago? What would be your advice to those guys?
I mean, all the money we made in hotel business, so that's what I said. This is a very good industry. Stay in it. It's really good, but be disciplined on what you do on it. I wish we had done some of the brands on early on that took us 10 years to realize, like Home2. Al is a champion. We haven't done as a company single Home2 brand, and which we're working on one of them, but I think Baywood has done a phenomenal job of building that Home2 franchise brand for their company and their enterprise. So some of the item, I think you kind of learn and lesson from many of the peer groups. So I would say 20 years ago, I wish I had done extended stay more brand. We have just started doing 10 years ago. So I wish I had done 20 years ago what Jack Dober and all those guys started doing that. And so that's one of the item I'd say we probably missed the boat on it.
The last recession, the Great Recession, extended stay was about 5% of our portfolio, and that 5% outperformed the other 95 during those years of 8, 9, 10. And we kind of made an internal decision at that time that we wanted it to be a full 50% of our portfolio in the future. And it's about 40-something right now, and it's about 95% of our pipeline or extended stay.
What percentage of your development pipeline is it?
95% of our
95%.
development pipeline, yeah, 40% of our existing portfolio is now extended stay.
That's a lot. Mitch, you agree?
No, I mean, look, Great Recession to even the pandemic that we went through, clearly we've learned a lot. Extended stay hotels have performed very well. Drive to markets, heavy leisure markets. There were markets that were all leisure that would stay away from, pre-pandemic. And now we're looking at, they were obviously well-performing assets, and we are now looking at developing in those kind of markets where we probably wouldn't have previously. But I want to touch on on something that we talked about a little bit earlier. We talked about a lot of things already in 30 minutes, but the rising, 3 things I think are creating this anomaly for greater pressure on values, which we all, those that own hotels that are in this audience, it's a good thing, right? Billions and billions of dollars are obviously chasing deals. 2, this doesn't get talked about a lot, but I think there's more clarity. I understand we've talking about so many disruptions and headwinds, but in 2018, 19, smart people were all hedging on that something is going to happen. And something big could happen, negative that is. Well, it's happened. And so if you look at all the experts, you know, with supply and demand, supply, you know, historically has grown, what, 1.8 to 2% over the last 30 years. Well, we didn't even hit that average for the last 10 years. So keep that in mind. And then the next 5 years, we're looking at 1.2% supply growth. And demand is obviously going to be robust. And so these are pretty smart people that have billions of dollars. There's some clarity. And then cost, construction costs. If you have a home that you paid $300,000 for a few years ago, and now it's the builder is building a $400,000 home next door, there's no NOI on a home. There's no cap rate on a home. But your home just went up in value simply by that home. Cost $400,000 next door, your home just went up in value. So clearly, because of all of those factors, values are going to go up. NOIs should go up. We'll see. You know, obviously challenging. We're going to talk about that with margins. But cap rates, I think, will go down because of those things.
Even if interest rates rise?
I am no expert on all those factors, but I believe even with interest rates, in the short term, at least because of those factors that we talked about. But a year from now, can that change? You know, some of these challenges, we're talking about construction costs, it's not about supply and demand necessarily. Non-residential construction starts are down. Non-residential construction starts are down, but yet costs are crazy. Labor, obviously, as Greg talked about earlier, is a big challenge in the construction industry, and probably will continue. But clearly, we just can't get things. And that's why some of these things have created that supply-demand problem.
And I mean, to Mitch's point on the cap rate compression side, I think it's happening right now as we speak, right? We're seeing it. I mean, Teague, you got like a front seat to it all. You're seeing all the trades that are happening. And I mean, things are trading based off of, they're not even back in some cases, back to 2019 levels, and they're trading at lower cap rates than they would have traded in 2019, still with the uncertainty of, you know, how these assets are going to stabilize out. So I think, you know, there's just so much capital, you know, chasing our industry. There's a lot of new capital coming in. I think the spread differential between us and industrial, multifamily, self-storage that have compressed down in a lot of cases, even sub 3% in certain markets. I think it just makes hospitality more compelling given that we're at, you know, elevated cap rates, and I could easily see cap rates coming down some even with, you know, interest rates rising.
Mehul, you agree? Where cap rates headed?
I think it's all within the part, because today, if you look at replacement cost, anything you look at, you know, buying today, first thing everybody looks at replacement cost or per key. And so based on what Greg and Mitch talked about it, cap rate will continue to shrink regardless of the interest rate, because it's, I think the interest rate is pretty much, you know, temporary factor when you look at it. It will not stay that, you know, high or whatever happened, whether we see all six hike this year. But I think cap rate will continue to go downward.
Al, you can answer, but I was going to head negative for a minute. So go,
Well,
give
you
your
know,
cap rate.
multifamilies are trading at the high 3 and low 4 caps. There's no reason why extended stay hotels, for example, specifically can't be at a 6 or something like that. There's no reason they have to just be at an 8 just because traditional hotels have always traded at an 8 cap. And so I think all of that, that's why a lot of this multifamily chasers, when they're seeing 3s and 4s on that side, I think a lot of that money is now also coming into our industry because the 7 and 8, it's just twice as good of a deal.
Yeah, feels like it. Oh, so therefore, are we in the right industry? Do you like our 7 and 8 cap versus the multifamily 3 cap?
I think we like today. We hope it goes to 5 to 7 or 5, 6 cap in next 12, 24 months.
Do you hope it goes that way?
Why
You're
not?
a buyer today. You're not a seller.
Well, when you look at it, but I mean, what's the difference with multifamily, right? If multifamily was 5, 6 cap, and now there are 3 and 4 caps, high rise or even, you know, 4-story building. So what makes our industry different, right? If you look at office, multifamily, industrial, they're the lowest cap. So what makes hotel different? In fact, our industry should be the most robust because we're able to fluctuate the rate overnight compared to any of those guys. So I think it's maybe all the broker has to do a better job of shrinking the cap down.
We'll do our part, Mehul. We'll do our part. Mitch, how's this recession different from the last recession, from the GFC specifically?
What was the last part?
From the GFC, how's this recession different from?
Yeah, so, I've been through a few. 2001, of course, in 2008, 9. This is what's different about this one. The last two were absolutely economic crisis, especially the Great Recession, right? This is a medical crisis. And so this has disproportionately impacted our industry. I'm on a CEO roundtable in my hometown. I'm the only CEO of in the hospitality industry. Obviously, insurance companies, there's Volkswagen and other companies that are represented. And in 2020 and 21, some of the things that we're talking about on stage today, they're not talking about those things. Their business has been robust. Their margins have actually improved. They, with people working from home, their office is closed, less travel, less entertainment. And I'm listening to this with these CEOs talking about this. And I said, who's on this panel here listening to this too? And they go, they have to back up a little bit and pander a little bit back towards me. But this is a medical crisis, not an economic crisis. And I said this last year, that the average American, their net worth, it's common sense, their net worth is in two places. It's in their homes and the market. Think about it for a second. What happened in 2001 to those two things? And what happened in 2008 and 9, those two things? And then what happened in 2020 and 21 to those things, those two things? Home equity values shot through the roof. The market's been robust, thus giving consumer confidence, right? Giving the consumers confidence to spend money. And they were saving money, of course, by being at home. And so people want to travel. People want to spend money to travel. They just couldn't because of restrictions and other things. So that is the biggest difference this time around. But as a developer, I'm going to put my developer hat on, I was ready when 2020, when the pandemic hit. We said, we're going to sort these things out. I was not ready for the pandemic, make that very clear. No one was. But when the pandemic hit, 3 or 4 months afterwards, we were hitting about 60% occupancy that summer. I said, this is the time to put our foot on the gas to develop. Just like we did in 2009, and the difference this time around, it did not materialize like we thought with land, with construction costs, and those kind of things.
Because to your point, everybody had money.
That's
I
right.
mean, people always ask, everybody wanted the deals and the bargain and all that sort of stuff. And my fundamental answer is the bargain's out there when no one has any money. And if no one has any money, that means you don't have any money either.
That's right. That's right.
If you have money in your pocket, guess what? So does everybody else. So the bargain will be there when you're broke.
I think take one challenge this recession. I think when you talk about recession, I think 9/11 and 2008-9. In Texas, we didn't felt anything. Even in COVID, we felt for short term, and it bounced back. But I think this COVID recession there's $5+ trillion money came into the market. So now that's kind of twice our GDP dollar amount that came into the market. So that was the unknown factor that nobody knew what to do with that money. Everybody had the money, what Mitch even talked about it. So the capital is there, and that money hasn't even came to the market yet. Everybody's look at all the, publicly traded company, they're sitting on a very strong balance sheet, a lot of cash. All the entrepreneurial, every single segment of even the office, everybody's sitting on pile of cash. They still don't know what to do with it. So I think that is what's going to happen in next 12 months. All that money will start to figure out where are they investing, what are they buying, what are they selling. So there a lot of stuff's going to uncover in next 12 months, I think, because we could see that endemic has already taken place last 30, 45 days ago, And now that money, everybody's sitting on that pile, I think you'll start to see. And I think that may be the opportunity where you will see acquisition cap may try to shrink because there's so much competitive out there, because there's so much money out there. Even though the bank are not lending, but all the money sitting in the bank still has to pay all those account holders some sort of money, whether 0.5% or whatever. So bank is also going to start lending at that point because they also see it. So there's so much going on out there, and none of them has reconciled yet. I would say those trillions of dollars out there.
But I think, I mean, part of, like, there's all this liquidity, right? And that's helping, I mean, the consumer balance sheet, to Mitch's point, is, you know, super strong. The corporate balance sheets are super strong. So this isn't, you know, again, it's not a true economic recession. I mean, we went to a very brief moment of a recession, but I think when you look at the valuation of assets today, I mean, they do look elevated within our industry. I mean, we're out there trying to buy assets, but then you start looking at what the potential cash flows are because of all these factors, because of all this liquidity and, you know, the strength of the consumer and the corporations, and the inflation in the environment. You know, the potential cash flows down the road are much stronger than what we saw in 2019 or even the outlook then, and that's helping drive some of that compression in cap rates too, just because of the growth that everyone's expecting to see. So, to that, you know, point, which wasn't your question, but
No,
just had to throw it out there.
But that's where I was heading there. And I really, for you, even I wanted to talk about the lending. Stonehill, Mehul's, with all the capital sitting on the sideline, how's that impacting debt? And will Stonehill get more aggressive in their lending? Or no, because interest rates are rising and because there's a Ukraine conflict, or lenders going to get less aggressive?
Right. Yeah, I mean, we're committed as a lender. We've been, you know, in the lending space under Stonehill for the last, you know, 8-9 years. So we're not, it's not a situation for us where we're going to stop, you know, lending in the space because it gets too competitive. Just the volume of deals may go down for us because we're going to, you know, remain disciplined to a certain degree. But the reality is, you know, we intend to, we feel like, you know, we have our sort of our place where we're competitive, and we're going to continue to, you know, provide construction financing. We do a lot of transitional financing on, you know, acquisitions or recaps of existing assets. So I think there's enough business, you know, for us to continue to do what we do on the lending side.
Al, let's get a little negative if we can. Labor's obviously a big issue, so I want to talk, get your thoughts on the concerns of our industry, margin compression being a major one, and labor being at the top of that list.
Yeah, I think, you know, obviously we're all feeling the extreme challenges of the labor crunch, and I think it's all brought on by a lot of these, the success that the country's enjoying. You know, the brands have helped considerably with us. You know, housekeeping is our major component of we're, you know, select service hotels, so labor is the biggest component of our expense model, and of that labor component, housekeeping.
Yep.
We have the most housekeepers, and, you know, you know, not cleaning stayovers has helped tremendously. And, you know, we've been lobbying the brands, I'm sure they're all out here, to continue that model.
You think it stays, or do you think?
And it's not necessarily to save money. It's, you know, we're going to spend the same money because we're paying 1.5 times to a housekeeper. Somebody who's making $12 is now making 16. You know, it's about the availability of the staff to help us to clean the rooms. And, you know, so the brands are going to have to do more, to be honest. And the brands have to do more in a lot of things. The brands have their hands in our pockets for many, many things. So a relicense fee, you know, 10 years ago was the same as the application fee, $75,000, $50,000, and now they want $175,000. What did they do different? You know, they just want a piece of our action. And, you know, sometimes now a tri-party agreement, a comfort letter, they used to do it for free. Now $3,000, $4,000, $5,000 for those things. So on and on and on, all of these things are causing our margins to decrease, and the brands have to do a better job, and, you know, we're partners with them, and so we have to, that partnership has to kind of, you know.
Mitch, comments?
Yeah.
You're the operator as well?
No, look, absolutely. I think we all saw this in 16 and 17 and 18, 19. RevPAR was growing at a record pace, and then our margins were diminishing. And primarily because of labor costs were going up. And then COVID, of course, the pandemic hit, and we were surprised in 2020 that our margins were actually even better in 19 with significantly less revenues because of what we were forced to do with our teams. And then 21 came, first 6 months, we actually had some pretty decent margins. But as we were bringing people back, almost at probably about 85 to 90% fully staffed hotel, we started seeing, obviously, those margins start eroding again. And I want to piggyback on what Al said, absolutely appreciate the brands that we work with and our brand partners on changing that business model. There's a lot of talk, and I hear a lot of this about going back to 19. We don't want to go back to 19. We want to go beyond
We can't.
19. And we want to have a more efficient model going forward because 19 wasn't actually a great year. And so housekeeping absolutely is our biggest challenge. Of course, in the food and beverage space, you're seeing breakfast standards change. 68 items were on the breakfast at Hampton Inns, brought it down to 28. And it's balancing brand equity and guest satisfaction and guest loyalty at the end of the day and profitability, right? But there's one thing that I have to add, guys. And we talked about how labor is a huge challenge, especially in housekeeping. There's no way some computer or some robot in the future, I don't even think in the near future, is going to clean rooms. So we're going to have people. And it's hard work with low pay, and that's what the industry is about. So this whole tipping thing, I want to just talk about this. So Uber, those that, obviously almost everyone here uses Uber. And the app, you could tip Steve. If he did a good job, you could rate him and tip him. And a month later, if I take my next Uber ride, it reminds me that there's Steve again, who did my drove the last trip. I can still tip him. So why can't we're so slow to evolve with technology in our industry. Why can't we simply, in our apps, if it's the Hilton Honors or Bonvoy or any of these various brand apps, simply have, I'm not going to be sexist, but Steve, our housekeeper,
Can I say something?
why can't we simply, we live in a cashless society, right? Who carries cash with them anymore? And we want to tip, but many times we forget or we don't have the cash to do it. And we heard from the speakers before to make things easy, right? That's the society that we live in today. And why can't we make it easy for Steve to get a tip for cleaning our room? And I think that's a game changer. You're paying $14 an hour, $15 an hour, an additional $5, $6 an hour that Steve would get would be a game changer in attracting more people in a hard industry, cleaning rooms.
Actually, totally agree with you. And I think the challenge is it's really on the brands, right? Like we're so underserved from a technology perspective, and I think it's just sort of looking at the model again, because right now the brands are so focused on franchise revenues, and they should be, but we need, in order to continue to drive more revenues, they need to look at how we can really utilize technology better, because it's so underserved today within our industry, and we can be more effective as operators, owners and so forth. So
Well, part of your mobile key check-in and somewhere in there is, would you like to tip?
yeah, mobile check-in. I mean, I think
Whatever.
there's stuff just to make it the way you communicate with the guests. I think there's just a lot of technology that's so underserved, and that could positively impact the guest experience. So.
All right, Mehul's chomping at the bit. Go.
I just want to build on, there are 6 issues that I see with our
Oh, God,
industry
here we
that
go.
great opportunity for us to solve. I mean,
Right.
there are great minds here. The first one is the brand. I think we talk about brand has to own some responsibility on technology, innovation. Their legacy brands are getting older. They're not really investing dollar in that part. So brand has some standard issues. There's so much stuff that brand can really help us. Second one is the cost. Our cost is continue going up. And that's where we need, this is all industry issue. I'm not going to talk about brand issue, but there are 6 fundamental issues in our industry that we all leader has to come together and solve for it. So first one, brand. Second one, cost. Third one is the regulation. fourth one is compliance, fifth one is a guest expectation, and fifth one is guest expectation, sixth one is the owner's expectation. So when you put all 6 issues and you talk about where the opportunities are, the owners are the last one on the line. A couple example when you talk about brands. Today, no brand understand really well digital space. If you look at Google Ads and everything, they're increasing smaller increment, 5 cents, 7 cents per click on it, that it's passed on to the owner. So everything is brands are outsourcing many of the digital space, where nobody's thinking. If you look at all our digital cost is going 90% off to digital space, the brand are outsourcing. So that's a really hidden factor that nobody's talking about it. So there's so many opportunities that out there. It's an industry issues, but we're just focused probably on one item. But when you talk about 6 items, how compliance is issue to us, regulation is issues to us, cost, guest expectation. So there's so much we could talk about, like housekeeping. When you look at it, we should start charging on it. As an owner, when you talk about 30% inflation, why are you not increasing 30% your rate? You should follow airline revenue management model. This is how we're going to take the industry back on it. So many of the item is very fundamental. It's an industry issue that each one of you have to take your own responsibility and bring it together. But look at airline has done very good job on the charging baggage fees. We should charge for housekeeping fees on it. And so many of those aspects, I think the industry can take over control rather than blaming it on brand or somebody, and we start making what's like parking. You could charge for parking surface, like in Texas, we started charging for parking surface parking. It's okay to charge $7. If customer refuses it, give them refund on it. But those are small aspects we could start changing our industry, and that's how we're going to make our industry very profitable, what multifamily and everyone has done it. You talked about Uber. Look at your last 30 trips Uber. Uber has started charging 15 to 55 cents surcharge, environmental fee, so everybody's tagging on nickel and diming. Nobody cares about that. Hotel industry is the only one that we're not doing nickel and diming, and everybody feels like we shouldn't do nickel and diming, but look at which industry isn't doing it. The biggest takeaway for our industry is we should do a prepaid. When you book a reservation, we should collect the money. If you look at how much money Expedia is sitting on the balance sheet, when you book OTA customer, the brand is okay for OTA to collect the money. But brand is not okay for collect the money for the owner because their technology is not compliant. This is where brand can invest. Each brand could invest $20 to $50 million in their technology, and we as owner can collect. If Al has 100 hotel, he could be sitting on $50 million prepaid reservation today. But nobody's focused on that item. So this is not so much a brand issue, this is industry issue that it doesn't matter who takes the first leap on it, but all the brand CEOs should really step up and say, we're going to invest a seed dollar, $50 million to solve that problem and make our owner put that dollar, prepaid revenue, once you book a reservation, it should be a non-refundable period. If you book anything, shopping, if you book anything, you have to prepay everything. Airline, reservation, everything, right? So why is our industry's lack of behind? So I think when you talk about fearless leader in our industry, the lodging leader, they're going to have to get a little bit aggressive and say, no, time has come to take over industry. And if not, I think all of the great leaders here, they're going to have to also speak up on it. So that's what I would talk about, the 6 industry issue.
Mitch, we talked about this.
No, I mean, look, well said, Mel. That's hard to follow what he just said. But I do want to touch on one of those items that you mentioned. I just want to reinforce this. But again, other industries are doing it. Airline industry. I remember when I went to Alice last year, not this January, but last summer, whatever. I had to change my flight like 3 or 4 times, and I think I paid more in change fees than my original airfare. Okay? Spring break, this Friday, rented a house down in Florida. Within 24 hours of booking, I had to pay half of it. And then 30 days prior to arrival, they take the other half. Good luck trying to change that reservation. And so we have to adapt. The consumer is ready. I don't know if the consumer is quite ready for a housekeeping charge. I don't know that, okay? I think that was a noble effort on our parts. I know our buddy Corey really took a big lead on that. And I'm glad that we have found some sort of hybrid in housekeeping now. But absolutely, this taking payment upon booking is something I think the consumer is ready for. And what's happening is, if you've got a restaurant reservation app, right? And you use that to book a restaurant a Saturday night. I will try to book another restaurant for that same night, and it will not let me, right? Because they know that I have a reservation already for another restaurant. The hotel industry, I could book 6 different rooms for the same day with the various portals that are out there, and then within 24 hours, because that's a cancellation policy, and they know their cancellation policies, right? And within 24 hours or 48 hours, I shop, I do some last-minute shopping, and so we're the only industry, as Corey Oakes says, our friend, that could tie up our precious inventory for 364 days without recourse. Think about that for a second. And so we have to adapt in many, many issues like this as an industry.
Well, the most one is everyone books airline ticket first, then they book a room. So if your airline is booked and if you want to change, you're going to pay a change fee. So why hotel cannot be prepaid? Once you book it, we should be able to collect it. And if you want to change a room, give it to your diamond member and all them free change one time or 5 times a year, something like that. But technology is the biggest challenge. The technology is not able to handle those modifications on all the brands. It's not one single brand. You talk about hotel industry, but look at Expedia has done a very good enough job, and they're sitting on billions of dollars on their balance sheet because it's our revenue. They're collected on our behalf as a custodian, and they're sitting on it, enjoying. And just on their $1 billion, the interest that they earn, they're able to spend more money on marketing. And here, that money is not available to us or the brand.
I'm glad I got you guys started. Al, we're wrapping up. Any comments? Any visions for 22? Any labor conversations?
No
You gonna
more
sell your
labor.
management company
No
like
more. We're
Mehul
not
did?
selling. No, we're not selling anything to anybody. We'll keep pruning and planting our portfolio as we've always done.
Yep.
We'll sell where we think strategically it makes sense for us, and we'll develop where we think that growth will occur in the future.
Mitch, my point, even Greg, but Mehul, I said jokingly, but for everyone, Mehul fundamentally decided the operations of this business were still difficult. And one of my concerns about operations is it's tough for the smaller guys to do it. You got to get some size. There's going to be some consolidation going on. You're going to have to figure out how to have a chief labor person in charge of all of your, to keep the team around and to keep the morale around. And what we're seeing a lot is when people are selling their management company, Mehul, selling it to Aimbridge or selling it to someone and just saying, I can't do it. There's economies of scale. Mitch, do you see that going forward, or do you think everybody's going to stay in it?
No,
This is what we
absolutely.
do.
I think that's going to continue going forward. I talked to a lot of my peers that have 10 hotels, 15 hotels, 25 hotels, and more, and their heart is in the deals. To get deals done, development, and operations is something they felt like they had to do, right? And you don't have to actually do operations. There are very good companies out there that can manage your hotels, probably equal or better than probably you can. And I have learned, I think, one thing that I've learned during this pandemic is you're either all in or you're out in operations. You can't be half in. This is a service business first and foremost before a real estate business. And if you don't have an incredible service culture and you're about your people first, and that kind of culture that you've developed in your organization, you will not succeed in this very difficult labor environment. And by the way, this labor challenge is not going away. This labor challenge is going to continue. We, as a developed country, of all the developing countries in the world, 30 years ago, we were like number 1 in workforce participation. We are like third to last now.
Yeah.
And Chip Rogers said this other day that the fastest growing demographic is 60 and up entering the workforce. And that's the future. So I think because of all those things that you're going to see people get out of management, and the infrastructure costs, the technology costs, the people that you have to bring aboard when you get to 40, 50, 60, it's very challenging.
Yeah, and I think, I mean, you're seeing it right now. I mean, there's so much consolidation where I think anyone that's got less than 20 hotels, does it make sense to operate yourself just given the costs, you know, associated with running an operation platform. So we have our own, you know, platform. We operate over 80 hotels, and we're committed within that company to being an operator and being best in class as an operator. But it's, I mean, it's super expensive. It's not a very profitable business model. It's more of the ability to control your product. But, you know, ultimately, if you're less than 20 or 30 hotels, I don't know how you make it, you know, make economic sense.
We could stay here and talk forever. The clock is screaming at us that we've run over time.
Yeah.
Thank you guys so much for being here. This is the exact conversation I want to have